Entering a full position at a single price point is effectively an all-in wager. You are betting that your entry is the absolute best price you'll see for the duration of the trade. This creates immediate jeopardy. If the market is volatile and dips even slightly after you've committed all your capital, you have no choice but to sit through the drawdown, watching your account balance drop while your stress levels rise. The idea of perfect market timing is largely a myth. Predicting the exact bottom of a pullback or the peak of a trend is a statistical anomaly that few traders can repeat with any consistency. Professional traders use position scaling as a strategic alternative. Instead of a single high-pressure entry, they build exposure incrementally, testing the market's strength before committing their full intended size. This approach shifts the goal from catching a perfect price to managing risk through structural flexibility. You aren't guessing where the turn is, you're building a position as the turn happens. Professional scaling is dictated by strict risk parameters. Before the first order is placed, you must pre-plan every entry to ensure your total combined exposure never exceeds a 1 or 2% risk limit on your account. There is a vital distinction between a scaled entry and averaging down. Scaling is a pre-planned strategy used on high-probability setups, whereas averaging down is often a reactive, emotional attempt to save a failing trade. To see this in practice, we divide a one-lot position into 3 fractions, 0.3, 0.3, and 0.4. We enter the first 0.3 at market price, keeping 60% in reserve. As price dips to support, the second 0.3 lowers our average entry price. Once the trend reverses upward, we deploy the final 0.4 lot. The position is complete, built at an optimized price. This multi-stage execution transforms market dips into a pricing advantage. Instead of fearing a pullback, you use it to refine your entry and reduce the impact of initial volatility. Defensive management is just as important as the entry. Once the trade moves into profit, the focus shifts to locking in gains. When price reaches the first resistance level, we close the first 0.3 lot. This banks a guaranteed profit early, rather than risking the position on hope. To protect the remaining lots, we move our stop loss to the break-even point. This removes financial risk to the initial capital. We let the final 0.4 lot run. This captures the full trending move while profits are already secured. Holding a risk-free runner allows you to benefit from large market swings without the pressure of a reversal. You've already realized a gain, so any further upward movement is simply a bonus. Scaling out provides a mathematical buffer against sudden market collapses. By taking partial profits and moving to break even, you remove the high-stakes pressure that usually leads to emotional trading errors. There is a clear divide between reactive and methodical trading. While single-entry traders are often exhausted by the constant need for perfect timing, the scaled trader relies on a sequence of planned events. Pullbacks and reversals are no longer threats in this framework. They serve as the very triggers that activate your planned entries and exits. Operating this way allows you to manage probability like an institutional risk manager, rather than relying on the luck required of a gambler. Profitability in Forex depends on structured, incremental exposure. When you stop chasing the perfect entry, you gain the freedom to manage the market as it actually moves. Executing a multi-stage strategy requires a broker with zero-friction technology. To manage these precise fractions and entry levels, you need high-speed execution and minimal slippage. This is why professional setups are executed on FXNX. With spreads from 0 pips and ultra-fast order processing, FXNX provides the precision needed to scale in, scale out, and manage your trade.